Battle of the Plans, Roman numeral 5. A 69-year-old widow has a home and just over $1 million in cash and investments. But each year she has $75,000 flowing out with only $30,000 flowing in. Will her money last without her dialing back her spending? And are there any steps she could take to boost her chances? Stay tuned as the RLS boys offer their insights right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani. Here we've got the gang together again, myself with Erik Olson and Adrian Nicholson. Another great week, and I'm happy we're starting a streak now of all being back at the same time.
Yeah, is this our second week in that way?
It is.
Sometimes lose track. Well, it's great to be here. Adrian, how you doing?
I'm doing good. I agree with you, Roshan. I'm happy that we're all here again. We're being a little bit more consistent on being together, so I'm really excited and looking forward to a really good episode today.
Yeah, we're revisiting a popular concept, I should say. I wouldn't say topic, where we're back to our Battle of the Plans, and it's actually one of the episodes we've got the most feedback on, got the most viewership on. We've got a plan today, a client situation. It is hypothetical that we're going to break down for you. And Erik, why don't you kick us off?
Sure. Well, so the client that we're going to be profiling here is a widow who is coming up on age 69 really soon. Birthday coming up soon. Kids, grandkids in the area that this woman wants to stay nearby. We're going to call her Lynn, and she's got some income and she's got some assets that are sort of part of the equation here to make this whole thing work. So in addition to having her home and such, she's got about $800,000 invested. She's got $240,000 in cash, some of which is committed for the remainder of a home improvement project. She has an IRA on top of those non-qualified assets that I talked about of 125, and then a tiny little Roth. And then in terms of her expenses, she's just on in terms of real estate, home insurance, maintaining the home, and that sort of thing. That's almost $16,000 a year. Plus, in terms of her mortgage payments, that's almost another $10,000 a year. And for right now, she's still making payments on a vehicle. That's about $5,000 a year. So she's got some very limited amounts of insurance coverage, but for her sake right now, the main thing is in addition to her car and her house and such being covered, she's got Medicare, she's got Medicare, a Medicare supplemental insurance plan. So you can understand the basic composition of those costs. And then on top of that, she has a regular monthly expense of about $3,000 and then wants to do some vacationing. And so she's got earmarked in the coming few years 3 different vacations, each of $4,000 each, so she can go spend some time with some of her friends. So now the question is, and then I should also hasten to add that Social Security income is the one and only source of income. She's not in the workplace. She doesn't have a pension. So that's $30,000 a year right there. So what we've done is to look at a number of questions and ask, among other things, what's the sustainable level of spending? Should she do Roth conversions? What should be the optimal way in which she pulls money from various accounts and so forth? And so we'll go through a number of these kinds of questions. But one of the things we just want to highlight is this is a fairly, what we consider at least a typical client for our practices. And so if this applies, somewhat for you, then we hope you'll take away some insights from this and understand that different advisors and different planning tools and different planning assumptions are going to feed into the mix, and all of them may produce slightly different perspectives on what's feasible, what's viable, how long the money will last, all those sorts of questions. So with that as background, anything, gentlemen, that you want to add?
Not with background, but I would say what you touched on to me is the first and most important question. Does she have enough? Right? Will what she have be enough for her? You said, is it feasible and will it last? So, um, Erik, I'll start with asking you on there. What did your analysis look like? Did she have enough?
Yes. Well, it depends on which of the tools that I use. So in this case, I had said in the first instance, I used three different pieces of software, and I used the first one. I'll just go ahead. We're not trying to promote these. It just happens to be the three that I used in this particular case. One is called Right Capital, another is Income Solver, and another is called Income Lab. And they gave somewhat different results or answers to that question as to whether or not she'll have enough. But the single biggest determinant of whether they said she'll have enough is whether or not they assume that the markets in the future are going to be generous and bountiful, or whether they tend to have more subdued expectations. So I will say that Right Capital said absolutely she's locked and loaded. She's gonna have this, barring some really disproportionate number or disproportionately high number of years of high inflation and low market returns, that there's almost no chance that she would have to make any sort of spending adjustments. And she could make it all the way out into her age, which I used age 94 as an assumption here. She could make it out to that life expectancy age and not really have any meaningful worries about having to make spending adjustments. 13% chance that she would. But as part of that mix, what that assumes is that the returns to the stock portions of her portfolio are in the 11s in large part. And so, the interest or the yield on her fixed income is going to be close to five, between 5 and 7, somewhere in there, high fours to high sixes in there. So it's really generous assumptions that this software tool uses as the base case for how things are going to work out. I can talk about some of the others, but what about for you?
Yeah, that was surprising because I thought it would be you start off more expense driven, but you touched on the growth rate aspect of it, which is just extremely important because the type of returns you get are really going to make an impact on those projections, especially you mentioned Erik going out to 94. And those growth rates will determine whether or not, well, it's a part of it, whether they should be making some adjustments with their expenses. So it's not just completely expense driven, it's the type of growth you're getting from the investments that you have.
Mm-hmm.
For sure, those are two of the major inputs, right? Expenses and projected growth rate. Well, first thing I'll tell you before I go into the software is, um, and I'm open to pushback from both of you, but I feel like what I've learned over time is there's so many assumptions in a financial plan that you use it as a guide and
Mm-hmm.
not as fact. So, uh, and
Mm-hmm.
Erik, when you went through all the investment rates assumptions that are needed, um, some of those numbers just seem so high that how are you gonna? I wouldn't believe that plan, so to speak. So if you were sharing that with me, I would say
Mm-hmm.
those numbers don't make sense. Now on our software that we ran, it does there are two ways that we look at it. First is how long do they think it'll last, and will her assets last? And it was a little short for her. Then there's a Monte Carlo
Mm-hmm.
simulator that looks at it and gives her a probability of success number. Now, once again, I'm going to share the number, but don't hold it as a law. As I said, use it as a guide. But this is saying their number is a 53% probability of success. And I'm not
Mm-hmm.
surprised at that, roughly 50-50 chance of success in her case. So your question about making, or I don't remember if it was a question or statement at that point about making adjustments. I think she'll have to make adjustments at some point. It doesn't necessarily mean she has
Mm-hmm.
to do something today, but at some point in the future, she may have to make adjustments. I'm thinking about lowered spending, maybe a housing type change. But the point being, there's so many assumptions in here. If she doesn't want to make any of those changes today, I would tell her, you don't have to make them now, but we've got to monitor this because you need to know that in the future you may need to make some adjustments.
Well, that's a great point, because when those use the Monte Carlo probability, and a lot of times I think the makers of this software or these types of software are actually mislabeling what that means. They're describing it oftentimes as, in your case, I think you said a 53% chance. Was that it?
Yes.
Yeah, as they describe it as a 53% chance of success, which implies that then 100 minus 53 is a 47% chance of failure.
Yeah.
And they don't then define what failure really means. Does that mean I have to move into my kid's basement and eat top ramen and Alpo? What does that
Well,
mean? And I think a much better way of approaching it is to say it's a probability of not needing to make spending adjustments, or conversely, a probability that I will have to make spending adjustments in absent any other, some of the variables in the market.
well, the probability of success is defined by running out of money. So without making any
Right,
changes.
without
So,
making
so maintaining
adjustments.
current
Yes.
spending plan and lifestyle adjustments, if she does not make any changes, she has a 53% chance of success and a 47% chance of failure based on the software. But like I said, depending on the client,
Hmm.
and if she's someone who doesn't want to change anything with that 53%
Hmm.
number, my conversation would be prepared to make that you may have to make some changes in the future, but this is something where we can monitor it along the way, because uh, based on her current situation, even though they're saying a 53% of success only, the other analysis of when they anticipate her portfolio running out of money is at age 99. You and I have talked about
Hmm.
how we differ on what we have for our assumptions in there. I have age
Hmm.
100 and you
Hmm.
run an analysis on their age. So that's why you're seeing that number. If I changed our life expectancy to 95, I believe is what you said you used, Eric,
I said 94.
94,
Hmm.
it would definitely change that outcome and that probability of success. I'll actually make that adjustment just to give you an update on what it would look like, just while we're comparing the Monte Carlo simulation specifically. Um,
Hmm.
so give me 30 seconds and I'll tell you what it
Yeah,
looks like. It's loading for
sure.
me.
And while you're doing that, let's come back to that. I just want to say to our listeners that that probability of success, again, it's a terminology that I differ with, and I credit my sort of change of outlook on that to the people who devised the software that I'll talk about a little bit later, called Income Laboratory, because there they frame the conversation as probability of no adjustments, or probability of needing to make adjustments. Because who in reality waits for that ominous phone call to come from their bank? Eric, did you know your checking account is completely bone dry?
Yeah.
No, really? But one more piece of bad news, Eric. Did you know that your investment account is also completely empty? No.
Yeah.
So no one actually operates like that. They watch what's happening and they make adjustments accordingly. And so I would say, on the one hand, you can say the software says 53% chance of success. I would say you could say it's a coin flip as to whether or not this client would need to make spending adjustments. And what would be the scenarios under which she would not? Well, if we were blessed with an unusually high number of low inflation years and high market return years. And what would be the scenarios under which she would need to make spending adjustments? Well, that would be the converse of that, meaning we got more than our share over the remainder of her lifetime of poor market returns and/or unduly high inflation. So you were going to make the change to age 94. How does the new Monte Carlo likelihood shape up?
Now it's a 91% probability of success. So once again, taking the
Okay,
terminology you don't
so
like out of there, which once again,
yeah.
that's pretty much what I expected, just because before, when we had at age 100, the expectation was she's going to run out of money around age 97, 98. So if I move it back to
Uh-huh.
94, the software now thinks, okay, she's not running out of money. So
Hmm.
therefore, the probability of success is going to go up, because that would the only scenario where she wouldn't have success then is if we had an extremely negative market cycle.
Hmm. Hmm.
So an
All
average or
right,
above
great. So
average,
we've
she'd do
addressed.
great, but negative, below average, she'd
So
take a hit.
Okay, well, good. I think we've touched on, some of the factors that feed into our thinking and our analysis about whether or not she has enough. And I would say, depending, as now we've illuminated for our listener, if we have a life expectancy, a difference in our assumptions, or we have differences in market return assumptions, both of those things can make a big difference in the outcome for the client. So, anything that either of you wants to add to that particular topic?
I think it was a great discussion showing how much adjustments and just looking at the whole financial picture can really just pay off in the long run and really help you see where you're at right now and just see what your options are right
Mm-hmm.
now, what you can make along the way. But I'm really excited to see what we have next and what's the next area you guys want to tackle.
Well, should she do any Roth conversions?
Yeah, this is an interesting one just because I think we got mixed results when we looked at this. And another situation
Mm-hmm.
where I say use it as a guide, not as an exact, and look at it every year. It looks like this may be a good option for her, but we'd have to talk about her assets, her risk tolerance. I think a little bit further on here, but in general, it looks like it would work for her. Just specifically to the Roth conversion question in general. What did you get, Eric and Adrian, in your analysis?
Well, Adrian, why don't you start?
Yeah, I too, when I was looking at whether Roth conversions would be a good idea just for her to kind of maximize the tax bracket she in. I did have her in a lower tax bracket and I had her going up as she got to the age where she had to start pulling money because of her required or minimum distribution of Social Security. I did have her moving up in her tax bracket. So her taking advantage of the tax bracket she's in now, where she can convert some of that money was pretty beneficial in her case, where if she didn't over time, she'd have to most likely pay more in taxes.
Mm-hmm. So, was there a specific sequence that you arrived at
Well, the one thing
in
that I
terms of
saw on
the
her
actual
analysis
Roth
that might
conversion?
be different, that you could probably maybe shed some more
Mm-hmm.
light on, I had her kind of capping out that the
Mm-hmm.
highest tax bracket that she would be in is around the 24% tax bracket. So I wanted her to maximize the
Mm-hmm.
lower tax brackets now before she got till she hit
Mm-hmm.
that upper limit when she started taking required
Mm-hmm.
distributions in her Social Security.
Mm-hmm. Yeah, well, it's interesting. So, in looking at her scenario, depending on the software, I had one of the tools that said her optimal strategy would be to right now take from, because it's impossible in my mind to really answer the Roth conversion question without simultaneously optimizing the question of what's the best way to pull money from our various accounts. So, I'm going to answer actually the both of those questions in conjunction with one another. One of the tools that we use said, yeah, absolutely do some Roth conversions, but do it now while we're in this phase where we have these lower marginal income tax rates, meaning through the end of 2025, as we've said before, the bracket, the layers of your marginal income tax go from zero. That's the part that you get to use either your standard deduction against, or if you itemize, then your itemized deduction. Then the next layer is 10%. The next layer is 12, but that's scheduled to sunset at the end of 2025 and go to 15. The next layer is 22. That's also scheduled to sunset and go to 25. And then the next layer now is 24, and that's scheduled to go to 28. So in her case, one of the software tools that we said is she ought to be thinking about this year taking money out of her taxable accounts first, meaning not turning to those IRAs. And that's an easy thing for her to do, right? Because we've already said she has more than $1 million between her cash and her taxable investments in that category, but only $125,000 in her IRA. So it's a very unusual pattern in that way compared to many clients. But in this case, she should be thinking in terms of going up to the top of the 22% bracket now, and using that moment or that window of opportunity to do that with about a $60,000 conversion this year. So but another one of my software said, well, wait, no. Have her, if she's got room in her 10% bracket now, you could do tax Roth conversions, I should say, up to the top of her 10% bracket if there's any occasion for that. But starting in 2026, no, you actually, you don't want to be doing that. From that point forward, no more Roth conversions. And in practical effect, what that means is there's really not a lot of opportunity under that model for her to do much Roth conversions. Again, because she's pulling primarily from her taxable accounts. Thoughts about that?
Yeah, I think the sort of the common sense test to me would lean towards the second software that said do it only to the 10% bracket, just because
Mm-hmm, mm-hmm,
um, her minimum distributions are going to be pretty small because only 10% of her assets are in a traditional IRA account. And to
mm-hmm,
me, that
mm-hmm,
means she's going to stay in a low bracket. So then, in order,
mm-hmm,
I'm going to pay higher taxes at a higher bracket sooner if I convert more. I need the investment returns later to offset that, and that's a risk and time frame issue. And the fact that she's more uh, moderate, I believe, to moderately conservative, I think that that puts the odds against you. I'm not saying to ignore the software, but when I'm getting
mm-hmm,
conflicting answer from
mm-hmm.
these two pieces of software, the second one that says convert less seems to make more sense to me.
Well, I've gone back to the first software as well, just to say, well, what if what if we dial that down a bit and did it only to the top of the 12% bracket? And it looks like it's not quite as good, but almost as good a result. So there it would be in the current year that she would do about a $14,000. And then, in subsequent years, 11, and then maybe 4 or 5. So the grand total amount of converted would be somewhere in the neighborhood of about $30,000, something like that, over the course of the next 3 years. And then the window of opportunity for that afterward would no longer be there.
Yeah. And just worth noting as well, sometimes we'll have situations where people have an excess in assets where they have, their minimum distributions are a lot more than they need to take out or to live on. In her situation, that's
Mm-hmm.
not the case. As we discussed earlier, that she had just either just enough or just short of the asset level she needs. So, and
Mm-hmm.
sometimes you fill up the Roth conversion and you think, oh well, she's not going to need this money. It's not the case for her, which lowers the time frame for it to catch up. Um, let's move
Mm-hmm.
on from the Roth conversion to just say from a planning perspective, are there any other things that stand out? I do want to spend a few minutes talking about investment strategy for her as well.
Yeah, let's move to investment strategy. One of the questions that we had talked about addressing there, at least that's still interesting for me, is should she differently position her overall moderate allocation in the three tax buckets she's got going: taxable, tax deferred, and tax free?
I mean, to me, the answer is yes, right? You want to make sure you've got the most tax efficient portfolio you have, especially in a situation where you're sort of threading the needle to make sure you have enough in assets. So I think she
Mm-hmm.
needs to take advantage of every opportunity available to save some money in taxes to keep it in her pocket just to help extend how long her assets will last.
Mm-hmm. And the common sense answer for me, Adrian, do you have anything to say about that, or if not, I'll just comment about this as well.
Well, expanding on more what Roshan said as well, especially that Roth IRA that she has, even though that's a small portion of her assets, just looking at how she can just use that account as best as possible, where you can withdraw from that account tax free. So you would want more of her aggressive assets to be in that account just to grow as much as possible because she won't be taxed on it. So that's kind of an example there
Mm-hmm.
that why it's so important for her to take advantage of these accounts right now on a tax basis.
So we call this tax, or we call this asset location as opposed to asset allocation. So asset location, one of the things that was a surprising result for me, because intuitively I agree with everything you both have just said, but when I went through it, at least using one of our tools, which I've mentioned before, Income Solver, it said, you know what, in her case, ironically, it doesn't make sense for her to do that. She'd actually be better off at the end of her life if she just kept a uniform allocation across these various accounts. I don't have an answer as to why that would be, especially since she doesn't have a lot of embedded capital gains in her existing positions. And so on that basis, it doesn't seem to me that there's a tax penalty to her I'm using that in the informal sense of it. It's not like there's a tax cost to her to reposition some things in her portfolio and to have more in, as you said, the growth oriented things in the Roth, small as it may be, the tax inefficient bonds in the IRA, and then everything else in the non-qualified account. But sometimes, the underlying variables here work out a little bit differently, and that's, I think, why the tools that we have at the very least provoke some reflection on how it is that that the software could see one solution as optimal, especially if it defies common sense. At least that produces it in me as an advisor, and I'm sure in you as well, the question, okay, what's going on here that would lead to that result?
Yeah, I also I'm not going to task you with looking it up now. I'd also wonder how different the outcome is, because sometimes we'll have these tools that'll
Mm-hmm.
tell us, okay, you have $1,000 more if you go with option A versus option B, and then when you really think about it, you're like,
Mm-hmm.
all right, you're telling me it's $1,000 difference over the next 40 years, so that works out to be an insignificant
Uh-huh.
difference, and then I think you've got to go with your judgment of what makes sense right now. I'm not saying that's what the difference was in this scenario, but in her case, she's going to need income. She's going to need her assets, and she's going to potentially deplete them all the way down. I just can't see how saving a few percentage points in taxes uh, is a negative, or doesn't help the situation. So I bet the difference was minor in that. I would, based on what you said, look into it again to see if the outcome was any different. But from what I saw, it seemed to make sense to manage the portfolio in that way.
Mm-hmm.
Go more aggressive in the Roth and traditional IRA than she would be in the non qualified account from a tax perspective. Um,
Mm-hmm.
but
But you have, well, that's good. I think we're in a basic agreement about that. That's at least what our common sense tells us. So you had other thoughts, maybe though, about the investment
Well,
questions.
and I'll tell you what I was looking at were areas for her to invest with her risk tolerance, in particular with the
Mm-hmm.
current market environment. The fact that we've got, I just got an alert that the treasuries are at the 2 year at their highest rates since '07. So there are opportunities
Wow.
now where, as a
Mm-hmm.
conservative investor, she can hit her target rate of return. Uh, or at least get close to it with varying bond and fixed income products. So that's where this
Mm-hmm.
asset location question comes to mind to me as well, because what I was thinking is, okay, for a portion of her income, we can use her non-qualified assets, which are the biggest bucket she has. That's her regular investment account,
Mm-hmm.
to just
Mm-hmm. Mm-hmm.
generate income for her to live off of now, and then we could do the same thing in the IRA. Starting at 72, she's going to need that money to live off of. Not that she's got to get the fixed income portion now, but the final one, the Roth, we could put assets in there where there's no income generated at all, thinking that that would be the last bucket she would use.
Mm-hmm. So, all right. Well, so you're just saying that we'll just use direct ownership of bonds and have those be a significant portion of her income stream. Just now that we have these higher
Yeah,
yields.
and I don't know that it won't be all of it. It would definitely, but we could
Mm-hmm.
lock in a portion of her income stream, and a significant portion of her income stream at that could come from these, because you're looking at rates right now where you can get these 4 and 5 year bonds that'll pay you in that neighborhood, that 4 and 5% yield neighborhood, based on
Mm-hmm.
uh, her non-qualified portion of her portfolio. So at this point, let's take conversions or all that out of the table, just where the current values are. If she was able to get that kind of yield, she could cover 2/3 of her income needs, right? So
Yeah,
without touching the principal in those accounts.
there's. Mhm. Well, it is interesting. Yesterday, I was looking at Treasury yields, 1-year Treasury yields, and they were at 4. So, and with the Federal Reserve indicating that they're intending to raise rates by another 0.75%, I'm sure some of that's already priced into those Treasury yields, as I just described. But nevertheless, I would think once they've completed that step and then start signaling what their intentions are with future increases as well, which I believe will continue for a while, I wouldn't be surprised if you can get a 1-year that's yielding more than 4%, that's really pretty interesting.
It is. Now the one flaw in my logic in this is inflation. What we talk about
Hmm.
the Fed raising rates and so on, is that we would need more historically normal inflation than what we've got over the last year for it to work out for her. That's
Hmm.
that's the risk she'd take, which is why I said you do it for a portion and not all the portfolio. I would also vary time
Hmm.
frames on these bonds, right? Just because that'll help
Yes.
protect her from interest rate risk. If rates go up higher, for one, for two, that inflationary risk, if she has to reposition the assets because inflation was higher and she needs greater growth, it'll allow her to do that. So I wouldn't, even though theoretically, if we dumped all her non-qualified assets into bonds, we could cover 2/3 of her needs. I still wouldn't put all of her assets into bonds. I think she will need some additional growth.
Hmm. Well, very interesting. So I wanted to come. Was there more that you wanted to say about the investment decisions per
Well, I,
se?
I have a few other pieces on there that I'd mention as well. Where in the bonds,
Yeah,
I
go
would
ahead.
also look at possibly you could look at some shorter term CDs because those rates are up as well. And she's got a healthy amount of cash in the bank. So if that's a risk tolerance thing, she wants to make sure it's low risk. We could look at some CDs for her for that as well. Even we talking about treasuries, we can look at buying some treasury bonds directly or funds. That's just I was looking at the income to separating a portfolio between income and growth. So in that income side as well, some alternative investments, specifically some of these real estate investment trusts that she could get that are more non-publicly traded, that could be an opportunity to add to the income, but b you could have some potential growth in there. There's just a vast uh, variety of options in that group that you could look at. A couple other things I'll just throw out, and then I'll let you move on from there. But I would also think for a part of her portfolio, we'd look at individual stocks or preferred stocks as well for income on the preferred and some dividend yielding stocks, but also some individual stocks for growth. Once again, looking towards tax efficiency by making those moves. The real estate investment trust, the income would be tax favored because there's some depreciation going on, and you would also have the long-term capital gains treatment on those individual stocks, which is also a favorable tax move. So when you talk about asset location, I threw out some ideas of what to invest. It's also important to note where it is, with the Roth being the more aggressive and more the ETF or mutual fund portion in the Roth or the IRA from a tax efficiency perspective. And as I mentioned, the bonds, whether it's treasuries or corporates, the individual CDs, and individual stocks being more in the taxable or non-qualified bucket. Once again, just going for tax efficiency.
Hmm. Interesting. Adrian, did you want to add anything about investments, or
Well,
pass on
yeah,
that for
this would
now?
probably be another section that we talk about, but and Roshan kind of touched on it, the cash portion of her account, considering whether or not she should put that to work or not. And there's a lot of factors. Since this client has a lot of cash built up, maybe that's something they're comfortable with having. So it's more of a risk tolerance and kind of just seeing where they're at, how much are they comfortable keeping in cash, and then looking at those investment opportunities that Roshan just touched on, just having diversified and putting it in a way that lines up with the client's risk and also provides some growth, because how we touched on earlier when we are looking at their expenses and their spending level. If right now they're at a coin flip on whether they have enough assets to last their entire lifetime, then the adjustment on whether they should be investing more of this cash is something that they really need to consider and look at if they need that growth, especially if inflation is as high as it is right now. It's really eating away right now at that cash. So just looking at how much we can deploy in different areas that line up with the risk and time frame can be really beneficial for them to not run out of money and hit their goals. And that's just something else to consider. This client has 30,000 of that cash set aside for kitchen remodeling. That's something to consider. And the vacations they're going on. So just seeing how much little cash they can have and how much they can use to invest will really help the client out in this situation.
Mm-hmm.
And Eric, your software, you had said not to do the asset location piece. So, and I'm not saying you believe or
Right.
don't believe the outcome or how you'd move forward, but I
Mhm.
would like to ask,
Mhm.
what's the downside in doing it this way?
Well, in this case, the software, we'll
Yeah,
just stipulate that the
not
software is
you.
saying that she would actually, since she is cutting it pretty close to the margin with the combination of her assets and how she's allocated and what her spending levels are and such, it's saying, yeah, these things will probably last to see the finish line, but it's going to be a close call. And in her case, it says she'll have about 20% more remaining in her remaining spendable resources. Forget about the house for a second, but just the spendable assets. She'll have about 20% more if she doesn't do asset location. Instead, if she lets the allocation that is specific to her risk tolerance be uniform across her various buckets. I thought that was really interesting. So we'll just, in that sense, just again, it might be that when we get into the weeds and start saying, well, what if this or what if that, we change that outlook. But that's what I thought was interesting, that the software defied my common sense about her situation and said she'll be about 20% better off if she doesn't do that step.
And 20% is a huge difference too.
It is, but we're also dealing with, in her case, a relatively small remaining amount in the estate other than her home. So that's a factor there as well. Well, I wanted to just point out one more thing that I think is valuable about the topic I began with, which is different softwares will provide different insights. So working with advisors who aren't just locked into one particular framework and or more essentially unaware of other sorts of tools that they could be using to do a double check or even a triple check on your situation. I mean, Roshan and Adrian, I know the two of you use at least two main tools and both very sophisticated tools. And I think that's fantastic. I wanted to introduce a tool that I've begun using starting about 6 months ago. No, actually, I guess it's closer to a year ago now, and it's not my first tool of choice, but it's certainly a useful sort of perspective check. And what I really like about this tool, it's called Income Laboratory, is that it says we're not dealing with just some sort of randomly initial starting point for this client isn't some random position in all of history. No, we live at a moment in history where there are some observable facts about what's happening in the economy and what's happening in the markets. And we can go back into the US economic and market history and see if there are periods in the past that bear some greater resemblances to the period we're in right now. And then compare how, if you had retired at that point in time, or you at least were having a plan done at that point in time with, in this client's case, we're assuming a 25-year investment horizon. If you had 25 years to go, what would be a sustainable level of spending? And the simulations that have been run in the past on these sorts of things would say, if you started in such and such a year, the sustainable level of spending with the existing assets that you have and the existing spending that you have would have and the existing income that you have from Social Security would have lasted you this far. Whereas if you had the starting point for those 25 years had been at a different point in time, here's a different outcome that you would have had. Let me show you a graph that that I think is really useful. If you're a listener and not a viewer, then I'll just try to describe this as best as I can. But the essential message here is I think the same. So what we're looking at here is a graph of on the vertical axis, the amount of monthly spending you could safely do and still not put yourself in a position where you were in dire straits later in that 25-year horizon. And that's the vertical axis. And then on the horizontal axis, it's a timeline. And it's going back to, in the US case, 1870. And all the way over on the far right side is 25 years ago, because we're having this conversation in 2022. So this is running through essentially 1997 or thereabouts. So what this is showing is a mountain graph, and the mountain graph is showing, depending on the starting point, what a sustainable level of spending would have been, though you couldn't have known it in advance because you didn't know what future inflation would be like. You didn't know what future market returns would be like. But in hindsight, what would have been the sustainable level of spending on a monthly basis from that point forward, granted with inflation adjustments. And what you can see is there's two colorations on that mountain graph. One coloration is very light gray. That light gray is saying we're not in a moment of market history that resembles that very closely. And then the other color is a light blue, and that's saying, in general, not perfectly, but in general, what the economic environment we're in right now resembles the starting points that are shaded blue here. And what you can see is that on balance, the lowest sustainable long-term spending is what characterizes those blue zones, meaning, all right, maybe given the way things are in the economy and in the markets today, we should have an expectation of not being able to spend as much as we would have been if, let's say, we had retired in 1982, let's say, and been greeted by a market that was soaring coming out of the bottoming process in that the Volcker-Reagan induced recession, and rising really steadily throughout the 80s and the 90s from that point forward. So what taking an application now to Lynn, our hypothetical client's case, in Lynn's case, what this is saying is, hey, you might want to, it might be your preference to spend in the neighborhood of $9,000-$10,000 a month. Maybe a safer play here would be for you to think in terms of starting closer to the $6,000 level and figuring out a way to make that your initial starting point. If you do that, just 6,100 that you pull from various accounts, or actually pulling enough from your various accounts to augment your $2,500 a month in Social Security, you do that, and you'll be in a position where that will be for you, if the past is prologue, that will be for you a sustainable level of spending. Now, will you have to make adjustments? You might. You might have to make adjustments. How often? This envisions that you'd probably have the opportunity to make almost a 6% increase in your spending every couple of years. But by virtue of the way that markets go, there may be and in this case, it's very precise, every 17th year, you need to be prepared for the possibility that you'll have to give back the increase that you gave yourself 2 years before. So on balance, though, what this sees is that you'll have a sustainable path forward if you are willing to make some adjustments now and not have such a high lifestyle expenditure from the get-go.
that goes back to what you said about the Monte Carlo, right? People don't just wait till the account's at zero; they make some changes along the
Mm-hmm.
way.
Absolutely.
So yeah, it seems to me like the prudent thing is for her to make some type of adjustment, and I would say sooner than later.
Mm-hmm. Mm-hmm. Absolutely. Gentlemen, we've covered a lot of territory here. I appreciate the time. Is there any last comment or reflections on Lynn's situation that you want to offer our listener?
I'll tell you what's the things that stand out to me, and there were multiple topics we actually didn't get to touch on today. I'll just mention one of them, which was the risk of long-term care. That's a potential big risk. I think that
Mm-hmm.
that would need to be
Mm-hmm.
explored
Mm-hmm.
further with her. But aside from that, I'll tell you, to me, the
Mm-hmm.
takeaway is you've got to be diligent with your analysis, but also realize that you have to be able to analyze to review your analysis and then make a decision that your analysis is not law, it's just a guide. So that's how I would what I
Mm-hmm.
think the biggest takeaways from this are to me.
Mm-hmm. Adrian,
Yes, look
any
at your
thoughts?
whole picture. Again, this client had assets, expenses, their income to consider. There were a lot of pieces that went into this whole thing, and just looking at what adjustments you need to make, what things that you might have to look at and reevaluate, whether it's a year from now, or 5 years from now, or 10 years from now, is something that people really need to consider and look at, which goes into what Roshan says can help you lead to more informed decision making.
Mm-hmm. Yeah, and I think the thing, dear listener, that I want to leave with you is that you've undoubtedly seen in magazines or on television commercials or what have you these smiling couple typically that's sitting there and having a conversation with an advisor, and it's sort of charted out that you have this very sort of clean and simple number that you can arrive at, and if you hit that number, then you know you're all set. And I would say you should understand, and I hope that you do after having listened to this episode, that there's a lot more to it than that. It's also useful to understand what are the inputs into that conclusion that the number is this. And it's also important to know that there are things that you can do to shape whether or not that number is or isn't sufficient, and that can have something to do with your expected spending levels and your how you allocate your portfolio. So to put not too fine a point on it, but I would just say work with an advisor who isn't going to give you a super simplistic answer without any sort of context or explanation. And even more strongly, I would say, is work with an advisor who is willing to also question his or her own assumptions and uses a variety of tools to arrive at varying perspectives to give you more of a stereophonic view of what your circumstance is, so you can make, being dependent on some sort of proclamation from your advisor, you instead can be educated by your advisor to make an informed decision for yourself about what's adequate and what, if any, adjustments that you might need to make along the way, or at least anticipate possibly needing to make along the way. I think you'll at that point have a much higher degree of confidence, a much higher degree of or a serenity about your situation, because you'll be having a much more complete picture of what your scenario actually consists of, and what sorts of things are within your control and what sorts of things are outside your control.
Yeah, that advisor is building your plan. Make sure they build it to your specifications.
Mm-hmm.
Excellent. To everyone that joined us today, thank you again for listening. This has been the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, tell your friends and family, send the links out. Visit our website, retirementlifestyleshow.com, and we'll be back next week with another great episode.